On today's episode, we're going to take a quick look at the stocks that I have purchased in the past 3 weeks. And after we take a look at every stock that I bought, I'm going to take a look at a few companies and do a small stock analysis just to see why I bought these companies. So let's get started. Alright, so here we are in Excel. I exported all my data from my brokerage account, and right now we're going to take a look at all the activity in my brokerage account. One thing you're going to see is all of these are purchased stocks. And to be honest, since in the past 3 weeks, and actually it's been a long time since I have sold any positions out of my portfolio. So right now, all these are purchased stocks. And right now, for the past 3 weeks, I have purchased about $2,800 I have deposited about $2,800 into my stock account, and I have used it in these stocks. So we're gonna see right now, my portfolio is, this Excel sheet is actually sorted by symbol of portfolio of companies that I bought. So everything is in order, and I've actually color coded as well. And we're gonna see my most earliest buys, like I mentioned, are 3 weeks ago, so it's gonna be April 20th, and my most latest are gonna be today, May 8th. And this is just a follow-up to my previous video I did about 3 weeks ago, where I took a look at the companies that I bought 3 weeks prior to that. So I'm just keeping up that train to show what companies I'm buying. And like I mentioned, I deposited about $2,800 into my account. This is in the past 3 weeks. This is a little bit more than I normally do. On a weekly basis, it's 100% guaranteed that about $420 goes into my account after my paycheck. So I think I put about an extra $1,300 into the stock market than I normally do. But that's just because I see a lot of opportunities right now, and I wanted to proceed and take my cash. So out of the $2,800, I bought the following stocks. So I bought about $150 of Uber. I bought about $700 of Spotify, and that's one of the companies we're actually going to take a look at today. It's one of my biggest positions. And one thing, guys, these are not my current position size on these companies. Some of these companies I'm just adding on to positions, and certain companies I'm actually just opening a position. For example, Spotify, I took about 700 into it. That is a new position I'm opening. KRE, which is a financial ETF, I did about $300. That's another company we're going to talk about today. Southwest, I put about $50. Raytheon, I put $150. Microsoft and MasterCard and Nerd, I put about $100 in each. Nerd is an ETF about video games. It's a video game ETF, and I'm very bullish. If you're gonna see it, I'm very bullish in clouding companies. I'm very bullish in esports companies, and I'm pretty bullish in companies like Spotify, where it's more of a consumer product, and they have some crazy growth. Next, another company we're going to take a look at, which is another entry position, IBM. IBM I entered with about 425. Intel Core I put about 100. Dropbox is another entry position that I'm going to talk about. This is 250. And then Disney I put $100 in. Delta Airlines about put 45. Berkshire is one that I should have done it because I put about $330 in it, so it's actually more than Dropbox. But I've actually done Berkshire a lot, so I'm actually going to skip on that one right now and not talk about it today. And then with Google, I put $100. So like I said, most of these companies are actually just adding onto my current positions. And pretty much, I think I'm only going to talk about my intro positions, which is going to be Spotify, KRE, IBM, and Dropbox. And if you guys don't know, I'm pretty much do a stock analysis video on a daily basis, and most of these companies actually have a video. So if you guys want to check out my channel, don't forget to subscribe, don't forget to hit the thumbs up. It helps the small channel out so much, and I appreciate all the support. All right, so the first company we're going to take a look at is IBM. And IBM, compared to its all-time high, this company is still down about 21%. But if we take a look at when I bought this company in April 21st. So compared to April 21st, I'm pretty sure I'm up a little bit, maybe not by much. And like I said, I am here for the long-term game. So even though I did see a 5% gain in IBM there, these are companies I'm expected to hold for at minimum a year, unless some dramatic changes change, some dramatic things to their business changes. But I even saying a year feels like such a short time. are probably companies in theory I'm hoping to hold for over 5 years. So why am I bullish on IBM? First, let's take a look at this company's earnings results. This company reported Q1 non-GAAP earnings per share of $1.84. This is one of the few companies that we're going to see that's actually making money for investors in the form of earnings per share. Some of the other companies later on are pretty much just growth companies, and they don't have positive earnings per share at the moment, but I will talk about why I invested in them. Revenue for this company was $17.5 billion, and this is about 3.5% down revenue compared to the same time last year. So you might be like, Jose, why the heck are you investing in a company that's seeing negative revenue compared to the same time last year? And one thing that I mentioned early on in this episode is I am pretty bullish in the clouding companies. And IBM is a company that's actually pretty big in cloud. Cloud revenue for this company was actually up 23% compared to the same time last year with constant currency, and it's up to $5.4 billion. So close to 1/3, I want to say, right? A little bit close to 1/3 of this company's revenue comes from clouding, and clouding is increasing by double digits. So that actually makes me pretty bullish on IBM. There are other reasons, and let's just take a look right here. Right here first, I'm taking a look at IBM's annual growth. And one thing about IBM is IBM consistently loses revenue. Has seen a decline of revenue, and that to me is usually a red flag. And you might be like, Jose, you just talked about this. Why are you only invest in companies with revenue growth? Why are you investing in IBM? Like I mentioned, right, clouding, and not just that. So there are other things that have happened inside the business that I'm actually pretty bullish about. IBM did the most recent acquisition, and it actually closed just the mid of last year. On July 9, 2019, this company finally closed the acquisition that it bought with Red Hat. And Red Hat is a strong clouding software company that I think is going to help elevate this company's clouding revenue for the future. And I do think this was a great buy for IBM. Maybe I'm not 100% sure if the valuation was good, if they got it at the great price, but this company will be one that will help elevate that clouding revenue for this company. The second thing I am bullish about IBM is this company just had a new CEO. Looking at past information of prior CEO, the prior CEO did not even make it to quarterly transcripts. Like, he did not go to quarterly earnings call. What kind of CEO does that? And that kind of through a bad taste. But the new CEO actually came in April 6th, and based on how he's acting right now, I do think management is a strong way to see where the company will go. And at the moment, the CEO, like I said, he's only been at the CEO for like a month, but this guy has been in IBM as an engineer for a long time, and he was promoted to senior vice president in 2015. So he knows the ins and outs of the companies. Next, let's take a look at a quick valuation of this company. For companies that make money and are not a heavy grower, I like to take a look at forward PE ratios. So if you're not growing revenue ridiculously, I want you to be at least making money. So in December 2021, this company is expected to make $12.42. That gives this company a forward PE ratio of 9.76. To me, that's actually pretty cheap. I'm actually, especially for a company that I consider that I'm bullish in the clouding segment, and I'm seeing their clouding segment increase by double digits. That to me gives me a good taste, and that's my main reason for entering IBM. The next company we're gonna take a look at is Dropbox. And Dropbox had a nice earnings, and this company, if we take a look at the past 6 months, if we don't take a look at that peak, it was some crazy peak. Let's take a look at this highlight. This company is up about 10% compared to where it was just when this whole COVID-19 started to happen. And unfortunately, I just picked up this company, so I'm pretty much a little bit on the red because I bought earlier this morning, and I think I'm about 2% down on the company. But again, this is nothing for me. I'm here for 10 years. The first thing I really like about Dropbox is its market cap. This company's market cap is less than $10 billion. So this company, if it grabs a lot of more customers, this company's market cap can increase. I can see Dropbox being at least a 3-bagger or even a 4-bagger. And that means that in the future, this company would at least return 4 times of my value. Again, I'm not a professional, so this is just my thoughts, and I could be completely wrong. But with Dropbox, what we're seeing is Q1 non-GAAP earnings per share were 17 cents, which actually beat by 4 cents. And like I said, Dropbox is a video I did yesterday, and I was pretty happy of what I saw. Revenue for this company was $455 million. So you can see this is a very small company, but with very small companies, you usually see very high growth. This company saw 18% revenue growth compared to the same time last year. Now, if we are seeing about this, the only thing I really wanted to take a look at from here, I do talk about this mainly in my other video, but gross margins, this company has very strong gross margins of 78.3%. And this is pretty much a software company. So normally software companies have high gross margins, but it is increasing compared to the same time last year. Last year was 75%, now it's 78%. So that's really good news. And that's and just like I said, that revenue growth, if we take a look here, this company last year grew about, in 2019, revenue grew about 20% compared to 2018. In 2018, it grew about 25%. In 2017, it grew about 31%. So we can see this company's revenue growth is pretty strong, and it's still strong. Like I said, this quarter saw about a 19 point something revenue growth, 18%, so close to 20%. So this company still has some nice double digits, high teens, low 20s growth in revenue. And with such a low market cap, it's something that's definitely grabbing my attention. Next, let's take a look at this company's valuation. Now, this company has this is more of a growth company. So for a growth company, I wasn't expecting much of a PE ratio, but forward PE ratio for this company is about 25 2 years from now. So 25, even for me, I still think it's pretty cheap for a company that's giving double digit growth in revenues, and has a very high gross profit margins. All right, and so for growth companies, what I tend to take a look at is forward price to sales ratio. Forward price to sales ratio, for my investment, like I said, right, each investor is probably different, and everybody has their own type of numbers that they follow. Maybe someone might see that forward PE ratio of 25 and might be like, damn, Jose, that's actually pretty expensive. You're a fool for getting into that. But like I said, every investor is different, and these are just my opinions. Next, let's take a look, like I mentioned, so for growth companies, I tend to look at forward price to sales ratio. So normally I don't like to pay over 10 forward price to sales ratio on a company. So this company had about 4.5. So to me, it tells me, okay, it's somewhere okay valued. And with that forward PE ratio and this company being a strong growth, might as well enter position. So I decided to enter into Dropbox. Next, we're gonna take a look at Spotify. And Spotify for this company, I've actually just entered. So if we take a look at my entry position, most of my entry positions, my biggest positions, were at about 145, 146, 147. I did enter a little bit at 148, but I'm still up on my right now it's at 152. Like I said, these are stocks that I'm meant to hold for years. So I don't really care if it dropped 2%, if it went up 2%, 3%. But obviously at the end of the day, it's still a little nice to see the company continue to go up. So if we take a look at the past 6 months, this company, compared to where it was at, this company is up about 10%. So this is another company that's providing returns to its investors. So I'm pretty happy about that. I'm very bullish in just the voice segment, and I think Spotify is one of those companies that will be able to really grab the market in there. Right now, this company does have a little bit higher market cap than the other companies I've seen, minus IBM. This has a market cap of about $30 billion. So let's take a look at this company's earnings results. This company's Q1 earnings per share were a loss of negative 20 cents. So like I said, this is a very heavy growth company. And normally with this, you see a little bit of loss in earnings per share. This company's revenue was $1.85 billion, and it was up 22% compared to the same time last year. So this company is making close to $2 billion and is still seeing double-digit growth in the low 20s, which I think is pretty impressive. So next, if we take a look at just some of the highlights for their earnings, they saw increase in monthly active users, they saw increase in premium subscribers, they saw increase in ad-supported revenue, and obviously Spotify is one of those companies that has taken a huge gain due to the COVID-19. A lot more people are working from home and are probably listening to Spotify. But what I feel the consumer, again, this is just my opinion, consumer, once they get hooked into something, especially a recurrent thing, it's very hard for them to drop out of it, especially if it's a few dollars. So I think in the long run, this is still gonna help out the company. And they're still going to continue to progress. If we take a look at this company's revenue growth, in 2019, this company grew 28%. In 2018, again, another 28%. In 2017, it grew 38%. So we can see this company has a nice double-digit growth in the high 20s and sometimes even in the mid 30s. And like I mentioned, revenue this quarter grew about 22%. So it does seem like a very strong company growth-wise. And that's the main reason I entered this company. I wanted to diversify a bit my portfolio and also enter growth companies. I think at the moment I was pretty much just looking for big giants that were growing a bit, but now I also want to invest in companies that are huge growers. Let's take a look. Forward PE ratio for this company is pretty low. This company is not expected to make any money in the next 2 years, but we can see the amount of money lost is getting pretty good. By December 2021, this company is expected to be at least flat, which is actually pretty good news. And then let's take a look at this company's forward price to sales ratio. This company's forward price to sales ratio for December 2021 is 2.5. So again, to me, I consider that a low valuation for the amount of revenue this company will be collected. And that to me is actually pretty impressive. Finally, the last stock we're going to take a look at is KRE. And KRE is going to be pretty simple. This is an ETF that's pretty much following the banking segment. I did do a video about Bank of America, and I forget what other banks I did. And I'm pretty bullish on the bank sector, but let me be honest, the banking's 10Q reports are horrible, are boring to look at. So I instead just went on into the overall banking ETF, because look, the whole banking sector has taken a huge hit of about 35%. So this is actually pretty crazy. I do think the banking sector right now is in a strong position, and with the government's, in my opinion, it's going to be a very low chance of them letting banks fall, especially with banks with the CARE Act actually being used by the banks and banks actually making money from it, which I think which is completely a different moral situation, but in a business sense, it helps out banking companies as well. Positions are all banks, so they have First Bank, they have JP Morgan, Bank of America, and all these banks are only like 2%, 1% of things. So it's pretty much the whole financial banking sector. So that's pretty much it. I hope you guys enjoyed today's episode. Let me know what you guys thought. What companies are you buying? What are the past companies that you have bought in the past 3 months, in the past 3 weeks? And also, guys, don't forget to subscribe, thumbs up. I appreciate the support. And if you guys want me to do any company analysis on any company, make sure to post in the comments and let me know. Be like, hey Jose, do a company, do this company, and I will gladly do it if I have the time. So take care, guys, and have a good night.